friends, welcome to my channel. So today we are going to do accounting for sale on approval. So the basic concept of this chapter is that sale on approval is a type of sale. Basically sales are of two types. One is cash, another is credit. So sale on approval is basically a type of credit sale. And the main objective of sale on approval is to push up a new product. Now you will understand this objective when I will explain the process involved in sale and approval. So after this we are going to understand the process involved in sale and approval. Now what happens in sale or approval actually? The manufacturer or a wholesaler launches a new product. Now to attract customer, what they do, they makes an offer. They makes an offer of sale and approval. Now this offer attracts the customers and they buys the product. Now as they buy the product in sale on approval, so now they can give the payment after a specified period, suppose 3 months, and the approval of the product means whether the customer will buy or not. It depends on them only. This is the main facility of sale and approval, that the approval depends on the customers. Now the customer can either accept the product and pay the money, or he can return it. So the whole basic concept of sale and approval revolves around this word, which is approval, and its meaning is acceptance. So it depends wholly on customer whether they accept the product or not. So this was the main basic concept of sale and approval. So friends, after discussing the basic concept, now we are going to discuss the 6 cases based on journal entries. So after discussing these 6 cases, you can easily do the journal entry of this chapter. So case 1 is when goods are sent on sale or return basis. Sale and approval is also called sale or return basis. So in this case, customer or sundry debtor account debit to sales account. This will be a basic sale entry, and the narration will be being the goods sent on sale or return basis. The amount here will be is invoice price. Now the question arises that what is invoice price? Invoice price is equals to cost plus profit. So the manufacturer adds some profit with the cost, which is called invoice price. The profit is also called loading. Okay. Now case 2 is that when goods are returned by the customers. So suppose that the goods are not accepted by the customers, they had returned it. So in this case, what will happen? Sales account will be debited, or return or inward account will be debited to customer or sundry debtors account. So the amount here also will be at invoice price, because when we send the goods at invoice price, so the amount will be returned will be at invoice price. Now case 3 is that when goods are accepted by the customer. Suppose that the goods are accepted by the customers. So in this case we will pass no entry, means no entry will be passed in this case. Why? Because when we send the goods at case 1, we had already passed the sale entry. That means that sales account is already credited. So we are not going to credit it again. So that's why when goods are accepted, no entry is passed. Now case 4. When goods are accepted at a higher price than the invoice price. Sometimes what happens that the manufacturer sets the IP, suppose that at 250, and the cost price is 200. Now he wants to earn more profit. So he decides what? He decides that he will sell it at 300. But he is not sure about it, whether the customer will accept this price or not. So what he does, when the goods are sent, he records it at 250. 250 he records, but he tell the customer that I am selling you at 300. Means it depends on you whether you accept it or not. And suppose that if he accepted the goods at 300, then what happened? The sale price SP, that is 300, is higher than IP, which is 250. So we have to record one more entry for the difference of 50 rupees. So we are going to pass this entry, customer. So this will be again a more sale entry, because we are going to credit sale once again with 50 rupees. Again the sales account is going to be credited. So the entry will be customer or sundry debtors account debit to sales account. Now the amount here will be the difference in price, difference in IP and sale price. Okay, so this is the excess price above IP. In the previous case we discussed that when goods are accepted at a higher price than the invoice price. But in this case, that is case 5, we are going to discuss when goods are accepted at a lower price than the invoice price. So in this case what happens is that the cost price of the product is 150 and the manufacturer or the wholesaler sets the IP at 200. But the customer accepts the product at 180. So there is an indirect loss of 20 rupees. As the customer don't know the actual cost price, but we know the actual cost price, there is still a profit of 30 rupees, as 180 minus 150 is 30 rupees profit. But this is an inside story. Okay, so there is an indirect loss of 20 rupees because when we sent the goods at IP, we recorded it as 200, as we didn't know that the customer will accept at a low price. So the customer accepts at 180 rupees. So there is a loss of 20 rupees. We have to decrease sales account. Sales account to record this 20 rupees loss. Now the basic nature of sales account is credit balance. Sales account shows credit balance, na? So credit balance. So if we want to decrease sales account, we have to debit it, correct? Debit it. So you have to pass a reverse entry. So the entry will be this: sales account debit, as you have to decrease sales. With how much amount? Amount will be difference in price, that is IP and sale price, which is 20 rupees. So sales account debit the customer or sundry debtors account. So this was case 5. So after case 5 we are going to discuss case 6. This is a very important case and the last case. So in this case what happens that at the end of financial year, the goods are still lying with the customer and the specified time limit is yet to expire.
Friends, now I'm going to explain you this case with the help of the given situation below. Now suppose on 20th February, the wholesaler sent the goods to customer, okay? And he gave 3 months as the specified time period for approval. Now on 31st March, which is the financial year end, what will the wholesaler do? Whether he will record the goods sent as sales? No, he cannot record it as sales because the sale does not took place, because the customer does not give the approval that he accepted those goods. So what we have to do at the financial year end? So we have to reverse the original entry. So what was the original entry? When he sent the goods, he passed this entry, debtors account debit to sales. So how can we pass this entry? How can we credit sales account? Because the sale has not took place. So we have to reverse this effect. So in the original entry, sales account was credited. So to reverse its effect, we have to debit sales account and credit sundry debtors account. So the entry will be sales account debit to sundry debtors account or debtor suspense account. Now you will ask that what is debtor suspense account? Debtor suspense account is an account in which we record all those suspense items which are still waiting on approval. Okay, so this will be the entry, and the narration will be being the cancellation of original entry in respect of sales not yet approved.
So friends, after this we have to pass one more entry, which is regarding stock. So the stock with customer. The goods that we sent to customer are still on approval. They haven't approved the goods. So we cannot record it as sales. So we have to pass an adjustment entry. An entry to record the books in the books of account, the goods that we sent to the customer. So we have to pass an adjustment entry. So an adjustment entry we have to pass. So the entry will be stock with customer on sale or return account debit to trading account, and the narration will be being adjustment of cost of goods lying with customer awaiting approval. The approval has not been approved. The customer hasn't given the approval yet now. So one more thing in this entry, that the stock amount of this entry will be at cost price of goods, because the cost price is always lower than the market value. According to conservatism concept, stock will always be recorded at cost or market value, whichever is lower. So always cost price is lower than the market value. So we have to find the cost price of the goods or the stock that are still awaiting for approval, and we have to record that amount in our books of account. Okay. So friends, after this I am going to explain you this entry with the help of trading account. I hope that you all know what is a trading account and how to prepare it. So in a trading account, closing stock is recorded on the credit side of it. So the entry is what? Entry is closing stock account debit to trading account. So exactly in the same way we will record the stock with customer also. So automatically you can find the entry. What will be the entry? Stock with customer account debit to trading account, because it is crediting the trading account. So no need of mugging up the entry. We can understand it. So I hope that you understood this entry. So friends, now I'm going to explain you an important concept with the help of the given timeline below, which is based on case 2 and case 3. This concept is very important for your exam perspective and also for understanding the concept of this chapter. So now suppose that on 20th December a wholesaler sent goods to a customer of rupees 10,000. So when the goods were sent, what entry he will pass? Debtor account debit to sales. Okay. And on 31st December, when the year end, so what he will do? He will record it as sales. No, because he has not got the approval from the customer. So as we learned in case 6, we have to pass a reverse entry, and the entry will be sales account debit to debtors. Earlier sales account was credited, so we have to debit sales to reverse the effect. Okay. Now what happened on 2nd January 2019 is that the customer returned goods of rupees 5,000. So what we will do now? Whether we will pass a reverse entry again? No, we will not pass a reverse entry again, because we have already reversed the effect at the end of the year on 31st December 2000 entry. We have already debited sales, so we are not going to debit it again. So here no entry will be passed. Okay. So in the previous year we have already debited sales and we have already cancelled the effect of the original entry, so we are not going to pass a reverse entry again. So that's why while the sale return took place, we are not going to pass a reverse entry, so no entry is going to be passed. Now what happened on 5th January 2019 is that they accepted goods of rupees 5,000. So we are going to pass another sale entry, because in the previous year we cancelled the effect of the original entry. So now the entry will be passed customer or debtor account debit to sales. Okay. So friends, in the first year when goods are accepted, then no entry will be passed, and in the second year when goods are returned, then no entry will be passed. So this is altogether opposite of each other. And in the second year when goods are accepted, then we'll pass a normal sale entry. So friends, after this we are going to do a basic question to implement the concept that we have learned. So till now you have seen the trailer, and now the picture will begin, and the question is on your screen.
I hope that you read the question properly, and now I am going to explain you the journal entries of this question. So the first journal entry will be sundry debtors account debit to sales. This will be a normal sale entry, and the IP will be at 200 rupees into 100 pieces of gas stoves. So the amount will be 20,000. And the second entry will be for the deduction in price, in the selling price of 20 gas stoves. The customer accepted 20 gas stoves at rupees 180 each. So the difference in IP and the sale price is 20 rupees, so 20 into 20 pieces is 400. And the third entry will be for the stock that is still lying with the customer. So we have to reverse the original entry to cancel the effect of the original entry. So we have to debit sales. Earlier the sales was credited, so we have to debit sales in respect of 80 gas stoves not yet approved by customer. So 80 into 200 is 16,000. Okay. And the last entry will be stock with customer on sale or return account debit to trading account. This is regarding the stock that is still lying with the customer awaiting approval. And one more thing, that the stock will be recorded in either market value or cost value, whichever is lower. So always cost price is lower, so we have to find the cost price, and I have found the cost price in note 4. So the calculation of cost of unsold goods. So the cost of one gas stove was 150 rupees. So cost of 80 gas stove will be 12,000 rupees. Friends, I hope that you understood this chapter, and thank you for watching my video. And friends, I need a small help from all of you, that please comment all my mistakes so that I can improve them in my further videos, because I always learn from my mistakes and bad experiences. So guys, please comment my mistakes and stay tuned for more.